So today we're going to be learning chapter 2. Okay. Chapter 1, which is the introduction to accounting. Now this is going to be elaborating what exactly is the type of accounting that we will be doing in this class, which of course we know we're going to learn to be a bookkeeper and we're also going to learn to be an accountant. So without further ado, first off, we're going to look at the definition of what accounting is. So we did look at this yesterday, but here it is again. So the definition of accounting is pretty much the process of recording, summarizing, sorting, analyzing, pretty much all those kind of financial business transactions, or even just recording business transactions events. Okay, pretty straightforward. Now, before I go ahead and dive into our lesson, again, we're looking at financial accounting. We are also looking into merchandising, specifically merchandising. So in this case, we looked at the areas, and we're going to be private, and our main focus is going to be financial. Now, before we dive into that, for those, I know that you guys have some accounting background, but just a little refresher that when we're learning accounting, we also need to learn the language. So since you guys have experience of accounting, so you guys should be familiar, right? To receive is a receivable, to pay is an expense, to owe is a payable, property is considered an asset, and any obligations or anything that you owe, right, is going to be I'm sorry. Yeah, that's right. A liability, right? Obligations is a liability. So those are just a quick little examples that we do tend to see here. And I'm just giving you just a quick little heads up that we are essentially learning a new language. Okay. So let's go ahead and start with the accounts. So there are a total of 5 account types, all right? There's your assets, your liabilities, your equity, and your revenues and expenses. Now, revenues, right? They also have another terminology. You can also refer them as income. So that can be interchangeable, right? Whether you recognize it as income or revenue, it doesn't matter which one you use. Okay? But let's go ahead and go back up here and define what an account is. Well, an account is some kind of systematic way to keep your records organized, right? And we categorize them, or we organize or sort them by their account types. So, and I just discussed what those 5 types are, all right? Also, a key little notion or a key little factor that you would be able to separate them is that the characteristics behind each account, right? So our assets, liabilities, and our equity, those are called our permanent accounts, okay? Because at the end of the day, no matter what given period or given time that you're working on your books for, these accounts will never close unless you go out of business, of course, right? And I'll give you an example, right? So a typical asset would be your bank account. If you close your bank account, that's it. You can't do business anymore because you're done for, right? But would you ever, while you're doing your business, would you ever close your bank account for any reason?
Unless there's some kind of fraud, I don't know. I don't think you would, right?
You can have your bank account, what do they call it? Frozen, or like they freeze your account, right? Because they're trying to investigate what's going on. But
Okay, so freezing.
you will never ever close out your bank account if you're doing business ever in general. Okay. Where your revenues and your expenses, right? Revenue is considered the income that you create and that you produce for your business, and all your expenses is everything that you need to incur in order to run your business, to operate your business. So what these accounts are called, they're called your temporary accounts, because at the end of the day, or at the end of a given period, they do close out. And I will give you an example. Okay? If you own a coffee shop, right? Can you predict that the revenues, if you have a customer that's a regular customer, they come into your store, can you predict that they'll buy the same exact item every single day?
You can, but you could be wrong.
Exactly, right? Maybe for 20 days straight, they ordered the same thing, one regular black coffee. But what if that one day they're running late? They're like, I'm gonna get a regular coffee. I'm gonna get a frappuccino or a double shot, or what do you call it? One of those biscottis or little bagel on the side or something, a coffee cake, right? You can never predict revenues. Okay? Even if you had your number one customer that comes in every single day and buys the same exact item from you, you can never predict what they always order from you. Okay? And same thing with expenses. Besides a reoccurring one like rent expense, right? But rent expense is a perfect example because there are times where your rent expense is not going to stay constant because your landlord might one day be like, I'm upping your rent. You know, in this time period, you've been here long enough. I'm upping your rent, right? So there, your expense right there that used to be fixed is now no longer fixed because now they're charging you more rent. So in this case, your expenses can vary over time. It can vary, and every month, and it's depending on each month, right? Every month to month basis or whatever your period is, it will never be the same, right? This month you could be incurring advertising expense because you have your grand opening, or maybe this week you have a sale. Maybe next week you need to invest in, you need to buy some products, so you're going to do a purchase expense, and next month you don't have to. So this is a perfect measurement of how we can determine profitability, right? If we look into our income statement or our profit and loss, right? All we're dealing with is our income / revenues accounts and our total expenses accounts, right? And that's why they close at the end of the period, because that is one perfect measurement of how we can determine whether our company is making a profit or not. So that's why these tend to close out at any given period. And by closing them out, it doesn't affect the overall company, right? Because again, I gave you that bank scenario, right? If you close your bank, you can't do business because where's the money going, right? Same thing here. You can't close out your liabilities, right? If you owe people, even if you close it and you paid it off and close it, they're still gonna find some kind of way to come get you, right? Or you file bankruptcy, they're still gonna find their way to come get the money. So that is the example of why the assets, liabilities, and equity are considered your permanent accounts, and why your revenues and your expenses are considered temporary. Okay? So those are the 5 different types of accounts. There's only 5 and 5 only. There's nothing that exists beyond assets, liabilities, equity, revenues, and expenses. Okay? Now we're going to talk about accounts. Okay? So accounts, the way that we organize our information is going to be, we're going to use some kind of technique or some kind of organizing way to separate each account. So again, we already have our account types. Now we're going to expand each and every one of those accounts into a main account or a sub account or a contra account. Okay? So a main account is like the umbrella, or it's like the umbrella. It's a very broad and general kind of an account. So example of that would be an inventory, right? If you sell toys, bikes, sports equipment, right? And you decide to just throw it all in inventory. How are you keeping track of that? All right? So that's why you got to create a sub account which breaks down and gives the main account more detail. And when we talk into understanding the normal balances, they flow in a certain direction. And when I say flow in a certain direction, meaning that they if a debit increases them, then that's one direction they flow. Okay. And we'll talk more about that in a second. Okay. So a main account would be cash, accounts receivable, inventory, right? A sub account would be breaking down each one. So for example, we have inventory. I sell coffee mugs. That's going to give my main account more detail. And they typically flow in the same direction. All right. And then lastly that I'm gonna introduce is what's called a contra account. Now the contra account can give either the main or the sub account more detail, but what's unique about the contra account, right? The word contra meaning opposite, right? So in this way, we're gonna understand that when the main account is flowing in one direction, let's say debits increase it, then you can automatically assume with the contra account, it's going to flow in the opposite direction, which in this case, if my main account is a debit, then my opposite flowing direction would be a credit. And that's what a contra account does. It either or reduces the main account or it reduces a sub account. Okay? Right? Any questions in regards to this concept? Okay. All right. So then the next portion that we got to understand is left and right. Okay? You're always going to refer your debits as left and you're always going to refer your credits as right. When we look into our journal, you'll understand how it's organized, right? You guys done it before. Generally, you have three columns, right? Or I'm sorry, you have two columns. You have the left side of the column and the right side of the column. Pretty straightforward. You place all your debits in the left side and you place all your credits on the right side. Okay? Never ever refer debits and credits as increase or decrease, okay? Because when we look at our specific account, they both can either increase or decrease an account. So a debit can increase assets, right? But it can also decrease your liabilities. Okay? So never refer your debits and credits as increase or decrease. It's always either going to be left or right. Okay? With that being said, here we move on to our infamous accounting equation. Okay, so this is very, 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 very important that you know this because this must hold true when you're doing accounting, especially when you are the accountant and you're trying to piece together your financial statements. This must hold true. If it doesn't, then you found a discrepancy and you have to go back and find where that mistake was done. Okay? So this also goes along the lines of properly debiting and crediting each account. Okay? Now no matter, like I said, no matter where the transaction is, this statement must hold true. Your assets must always equal your liabilities plus your equity. Okay? Now we're going to go ahead and get in talking about each account. Okay? So we're going to go ahead and take our first one, which is our assets. So assets, right? The definition of an asset is pretty straightforward. It's anything and everything that you own with an N, okay? Own. Okay? So that can include your cash that you have, right? It's yours, right? It's yours. The property, the equipment, the building, whatever it is, it's yours. Okay? So that's how you categorize where it belongs to, and it's everything and anything that you own. Okay? And then we have what's called categories to further organize our information. And how we organize our assets is going to be based on liquidity, meaning how quickly can you convert it into its simplest state, simplest form, which is cash. All right? So that's why on my right side, I organized it like this. Cash is always going to be number one because it's already in its liquid form, right? It's already in its simplest form, which is cash, and it's readily available the way it is, right? Okay? And how we organize or categorize our assets is there's a total of 3 categories. You have your current assets, you have your fixed assets, and you have your other assets. Okay? So again, it's organized based on how quickly you can convert it into cash. So my current asset, right? Pretty straightforward, right? Anything that you can convert quickly into cash. So my cash is going to be it. My accounts receivable, right? Any money that people owe you, it's instantly cash because you can go and collect that money from anybody. Inventory, right? You can buy the inventory and you can quickly resell it out to the public and get cash immediately. Okay? Then we move on to fixed assets. Now, fixed assets, okay? Another word for fixed assets would be PP&E, also known as property, plant, and equipment. These typically have these kind of things typically are tangible. Okay. Another thing is that they have some kind of lifespan to them. Okay, and most often things, if you think fixed assets as of your property, plant, and your equipment, you can automatically recognize a piece of information and categorize it right under fixed asset, right? So, for example, your property that can include your land, your parking lot, your sidewalk. Anything that's considered property around you is going to be property. Your plant will be your building and everything that's inside the building. Okay, so your furniture, your chairs, your tables, your lamps, whatever it is, right? It's everything that's going to be inside the building. So that's your plant. And then lastly, equipment is anything that you need to operate, whether it's a machine, a printer, a copier, yes, anything like that. That's going to be considered your equipment. And understanding all of those 3 different categories, right? You can determine, right? If you buy furniture right off the market, you used it lightly and you decide to sell it. How easy can you quit? How easy is it to turn around and turn that into cash? Probably not that easy, right? You have to go, place it online, right? You got to take a picture and make sure that you fill all the details. That person gets in contact with you. They come and see it. You go meet with them, and if they don't like your couch, then you have to put it back up. And if they do buy it, right, they'll give you the transaction right then and there. They'll give you the cash or whatever form of money that they give you for. But one thing is, even though you sell it, you're not going to sell it for what you originally bought it for because it's used. So with all of that, and with the assumption that, let's say, you sold it, but it never was sold instantly, right? You had to put it back up on the website a couple times. How quickly can you convert your furniture? Okay? Not so quickly. Okay? So that's why it's categorized secondly. And again, I have my building, furniture, and I have equipment, right? My machinery. All right? Then the last category that we're going to talk to is going to be other assets. Now, typically what other assets are is going to pretty much be anything that doesn't fit in the first category or in the second category. And usually what you'll notice is that a good characteristics to kind of figure this one out is that they're intangible. Okay, so things that you can't physically touch. So examples will be any copyrights, any licenses, any deposits that you've made, right? Or even a prepaid rent expense, right? I'm going to ask you a question. You signed a contract with your landlord. Can you physically touch a prepaid rent expense?
No.
No, because it's probably in a piece of paper form. Typically, most intangible assets, right? They come in like a piece of paper. But can you physically, for the purpose of prepaid rent expense, can you touch rent in general?
Well, I don't understand, I guess, the question. What do you mean?
Like, can you?
I'm touching it when I'm paying it.
Yes,
I
yes.
mean, it's not my money. It's there. So
Right,
I
right.
think you can touch it. So.
In this case, we're not using money because money is considered an asset for us, right? But in this case, like the concept of rent, can you physically touch the concept of rent?
No.
No, you cannot. Same thing with copyright, same thing with licenses, right? Can you actually touch that protection bubble over your product? Anybody can touch your product, yeah, but can you, is that legal documentation? Can you physically feel that invisible bubble that's around it? Of course not. You can't touch it. So usually that's going to be a straight indicator that it's going to fall under other assets. Okay, and with that we have intangibles, so just such as deposits, prepaid accounts, or even like copyrights, licenses. Okay, so those things would be something that you would typically place under other assets. And again, with the copyright, right, you own the rights to it, so it's going to be considered an asset because you own it. All right, any questions in regards to assets?
Not for me yet.
Okay, all right. Now we move on to liabilities. Liabilities is going to be anything that you owe. Okay? So with an E, not with an N, with an E, you owe them. All right? So that can be anything such as maybe you have an account with a vendor or a credit card, right? They'll typically have they give you credit. You haven't paid them yet, but they allow you to pay them later. That's going to be something that you owe to somebody. Okay? And typically, the way that we categorize our liabilities is there's only two categories, right? One is going to be current, and the other one's going to be long term. Now, how we categorize or organize our information is going to be based on the time that you owe them, right? So, most current liabilities, right, usually you owe them either within a year, okay? So, for example, if you have a credit card with, I don't know, throw out a name, Sears, are they going to allow you to owe them in 1 year?
You mean to pay it off in a year?
To pay off in a year, yes, they can do that,
Well,
but
yeah, but typically it's monthly.
typically it's monthly. That means you owe them every single month. Never will you ever see them say, "Hey, you know what? You can pay me a year from now." Nuh-uh.
Right.
That doesn't exist in this world, and that's why an account's payable. If you have an account with them, typically you have that payment and it can be anywhere from 30, 60 to 90 months that you can that most companies would allow you to do. Okay, those that are 90 days are pretty generous, right? They allow you to owe 3 months later, but they also do that kind of incentive where, hey, if you I'll give you zero interest if you can pay me back within 6 months, but you still have to pay them every single month. So in this case, they still get you. All right, so that's going to be categorized as a current asset. Anything that's going to be long term is going to be more than a year. So most loans, go out there and figure out what kind of loans are there. Student loans, right? Typically, they'll let you borrow it within a year, and they'll let you pay it back within a year. They can let you pay it back within 3 years, 5 years. It doesn't matter, right? Most home loans today are anywhere from 20 to 36 years, right? You don't have to pay back until then, but you do have to make your monthly payment. But that's one of those loans that you don't have to pay right away. Most business loans, same thing. They'll give you like a whole year extension that you don't have to pay back until that it starts up again, and then you have X amount of years to pay it off. So in this kind of sense, anything that's more than a year is going to be considered a long-term liability. Okay, and then here again, it's any loan. So you're more likely to categorize, if you recognize a loan, it's going to be long term regardless. Okay, unless it's a short term loan, which there could be, there are very possible reasons for a short term loan. Now, with that being said, okay, notes payable can be both a current and or a long-term liability. Because with notes payable, right, you have the flexibility to renegotiate the time, right? You can change the time on how long you can either extend it, you can either what's that word? When you infer it, where you extend the date that you have to pay it back in. Okay, so that's, yeah, an extension, pretty much an extension. Yeah, so for most student loans, right? Oh, they expect you to pay right after college, but if you say, hey, I don't have a job yet, then they'll extend it another year until you finally get a job, and then they say, pay me back. But if you keep filing that paper saying, I haven't found a job yet, of course, they know. They can just run your Social Security, and they know, hey, wow, this person really didn't get a job. So anything like that, right? That notes payable typically can be extended over time, and you can oh, there it is, defer. That's the word I'm looking for. Defer the payment.
Right.
Yes. Okay. So one thing I want you to make sure and understand is liabilities is not debt. Okay, they're obligations for you that you have to pay. It's mandatory. It's required. Right. It's not debt that you owe. Right. I know that's confusing because technically it is debt, but again,
Right.
debt can be cleared. This is an obligation that you need to pay. All right. Any questions in regards to liabilities? Okay. Next section we're going to be looking into is going to be equity. Okay. Equity, I'm going to say this once and I'm going to say it twice, okay? Equity has no categories. I don't care what you're looking at, of course. This is only applied to private, of course, not for sole proprietors. But when you go into a corporation, they actually technically do have categories. But in this case, we're learning private, and under private equity, there or sole proprietor equity, there is absolutely no categories. However, there are main accounts that do affect equity. Okay? And I'm going to just give you some examples of them, but they're not categories, right? They only influence how equity flows, okay? So again, let me tell you what the definition of equity is. Equity is going to be the value of your company. Now, since you guys are familiar with accounting, if you ever go into real estate, it's a completely different terminology. Equity in real estate means the value of your house now that you've earned upon living in that house long enough, as in it's been aged. In this case, no. We're looking at equity as the value of our company. What is entailed? What is the total company's worth? Okay? And when we talk about that, the things that you will see is your capital contributions and your owner's withdrawal. So again, capital contributions, right? If your original investment, right, is going to be whatever amount, capital contribution is going to be more money that you invest into your own company. All right? Other than that, you're going to also look into owner's withdrawal, which takes away from your company, right? You're pulling money out of your company. So therefore, it's going to be an owner's withdrawal. Now, typically, when you're looking into corporate standpoint, equity also includes your profit, right? And your profit is going to be your income, which is going to be your revenues minus your expenses. And we'll talk about that as well. Okay? So revenues, again, is pretty straightforward. It's your money that your company is it's the income or the money that your company is increasing, right? It's your profit, right? So in this case, when we look into our revenue / income, right, we're looking at our main core operating business, which is in this case our operating income. Because we are focusing on merchandising, our main operating income is going to be sales. Okay? Whether we sell a service or whether we sell a product, it's going to be, that's our main operating income. That's the income that we're earning. Okay? Other categories that can fall in under revenues is going to be other income or non-operating income. Okay? So anything that you do apart from your main core of your business. So for example, I own a coffee shop. All right? My main core business is to sell coffee. But what I also do is I also make it convenient to do a delivery to deliver coffee to someone else. My main core business is to sell coffee, not to deliver coffee. So my delivery charges that I'm charging my customers is going to be considered other income. All right? If you partner up with another company and you purchase part of their stocks to help you boost your revenue, that's going to be considered other income, right? Dividends in another company. That has nothing to do with the core business, right? You're in the business of selling coffee, so you making money off of the dividends in another company is considered completely non-operative. Okay. And then lastly, we're going to talk about our expenses. So it is basically anything that you need to incur to either spend, use, or you need to make it an expense. You need to spend to operate your business. So in this case, we have 3 total categories under our expenses. We have cost of goods sold. Cost of goods sold is basically when we involve with selling our inventory items, right? So when we talk about it and we go into chapter 5, we'll talk about what cost of goods sold actually does. And it's pretty straightforward, and we'll talk about that later. But that's one of the expenses that you have to encounter when you're dealing with doing your daily operations for your expenses, okay? Other things, such as that doesn't pertain to your sales or to your revenue, is going to be your operating expenses. So things like your rent expense, advertising expense, right? Making your purchase expense. All of those are going to be considered expenses that you need to incur in order to operate your business. Pretty straightforward, right? Pretty straightforward. But you can't add rent expense to apply to the product of you selling your item, right? Because then your item should be over should be a ridiculous amount. if you're going to include the cost of rent. Okay? And in this case, no, it doesn't apply here. You're going to have to separately categorize it and sort it and organize it like this. It's going to fall under your operating expenses. Okay? And then lastly, you have non-operating expenses. For this class, I do not need you to know or truly understand non-operating expenses. That is going to be more advanced level of accounting. And in this case, we're looking at accounting at a 101 level. Very, very basic. But I will educate you guys though what a non-operating expense does. So for example, I buy inventory and I need to I don't have space in my own shop to store my inventory. So I rent out a warehouse, right? The warehouse is going to hold my inventory. It might need some temperature control. It might need a security because you want to secure your assets, right? So all of that, getting the facility, getting the security, getting the temperature control, electricity, whatever it is, that's going to be considered a non-operating expense because, again, your business isn't to protect your assets. Your business is to sell your assets, okay? It's whatever that's revolving with the property that you own, that is your core operations, okay? So I'll go ahead and use Walmart for example. Yes, they buy the parking lot behind the store, and that's where all their equipment is, right? Or all their assets are. It's in the back of the store. That is completely fine. It's on their own property. However, it's not part of the main operating portion of the actual store, right? The main store is what you're going to have to turn the lights on for to sell in order to have your customers go in and purchase the items from you, right? They got to take it to the register, right? All of that is going to be considered your operating. All the stuff that's in the back, in the inventory, in the shed, whatever it is, a trailer, I think they use trailers. Those are going to be a separate cost from your main core of your business. Okay? Any questions in regards to revenues or expenses? Okay.
I'm good.
Okay. So now we come and reach this little accounting model. So this is where I was talking about slightly earlier and how it affects your accounts in general, right? And this is exactly what I'm talking about. So when we look at our accounts and we look at how the transaction can affect each account. So in this case, we're looking at what's called a normal balance. A normal balance is going to be the positive side that a certain account is going to have. So in this case, right, I'll give you an example. The normal balance for an asset is going to be your debits, okay? Because they typically increase with the debits, and that's what the definition is. It's whatever side increases it to give it a positive number, all right, in a specific account. So in this case, we'll look at each example right now. We'll look at each account right now. So my assets typically are going to be debited, and they're going to increase with the debit side. So for example, I received cash, right? I'm increasing my assets, right? Because I started with 0, now someone's giving me money, so I'm increasing the amount of cash I have. And in order to increase that, you're going to debit your account. Yes? And if I were to spend that money, right, and get rid of it, so I'm going to go for 100 to 0, I'm decreasing my cash. So therefore, I'm going to decrease it with a credit. And we'll talk more into this when we move on to chapter 3, which we talk about how and what are you increasing the amount by. Okay? So that is an example for assets right there. Liability, same thing. You go to the bank, you get a bank loan. You're going to increase the amount that you owe. So in order to increase it, you're going to credit the account. And every time you pay off your liability, right? Every time you make a payment to the loan, you're going to decrease the account with a debit. Okay? Same thing, not same thing, but likewise with your equity is if I added more money, if I contributed with my capital, then I'm going to increase it with a credit. But if I were to pull money out of it and withdraw from my company, I'm going to decrease my account with a debit. Right? Sales is actually really funny when it comes to revenues and income, because most people, when they recognize sales and income, they automatically associate it with I made a sale, so therefore I need to debit it, or that's the first thing I think about. That's I just made money. No, in this case, sales is a figurative concept, right? You are selling something, but you're receiving cash for it, right? So you're increasing an asset, but you need to have an equal and opposite flow of credits, which in this case, this is how revenues and income works. They flow in the opposite direction from an asset. So in this case, I will, if I made a sale, right? I've earned my revenue, I earned my income. I'm going to increase it with a credit. If I have a sales return or someone returned the product for me, in order for me to decrease my sales, I'm going to debit the account. Okay? When I'm looking at my expenses, right? If I have to incur revenue, rent expense, right? I have to pay somebody for that expense for that month. I'm increasing my expenses. So in order to increase it, I'm going to debit my account. All right? And then if I were to decrease it, let's say I made a purchase expense, but I returned the item. So now I need to decrease my purchase expense. Then that's where I go ahead and credit my account to decrease my inventory items that I made a purchase for. So in this case, I am going to decrease it, right? One point to get away from this and try to understand this is going to be the key thing that you need to have all over the place in order for you to understand a transaction at hand. And we'll talk about that in chapter 3 when we talk about the transaction analysis. This right here is going to be very important. All right. So in the Google Classroom, I've already posted a separate sheet for you to print out, post it all over the place, put it on your refrigerator, put it on the bathroom door, just so then you can ingrain this in your head. Okay. So it's very, very, very crucial that you utilize this to help you out with your transaction analysis. Okay. So one way to get away from this is your assets and your expenses are always going to be increased with debits. Everything else is the opposite. Okay? So your liabilities, your equity, and your revenues are going to flow in the opposite direction. Okay? And this is exactly what I was talking about when I was referring to the main account and the contra account. If your assets, normally the main account for assets is going to be a debit. In order to decrease it with a contra account, you're going to have a credit balance. Okay? Any questions in regards to the accounting model at all?
Yes.
All right. Again, when we move into chapter 3, you'll understand how this applies. Okay?
This is the one that we're using in journalizing.
Yes, correct. Correct. This is what we're going to be utilizing in journalizing. Correct. Okay. So let's go ahead and look into the bookkeeping systems. All right. So there are two different types of systems that exist in accounting. There's single entry and then there's double entry. Okay. Under single entry is you're literally only recording your transaction in one direction. Pretty straightforward, right? So example of this would be a checkbook, right? When you write your check, you record it in that little check ledger book thing that comes with your book, right? That's only one place that you record it. Now, that is single entry, right? If I were looking into a double entry, right? If I'm writing a check out, I record it in my ledger, right? Saying that I wrote a check out. And then I go into my contracts and I look up my contract and say, boom, I'm going to record this in rent expense as well. Then that's where you're diving into double entry. Okay, so in a sense or in a nutshell, single entry is pretty straightforward. You're recording only in one place and only in one account. When you're doing double entry, you're recording in two or more accounts. All right, and this is where this concept, right? All debits must equal all of your credits. Okay, so this is where we're going to apply some science in here. Same thing, the same concept is going to apply. If you have an action, you need an equal and opposite reaction. Okay, if you have a debit, you need an equal amount of credits. So this is going to be very, very important when we dive into chapter 3, when we look into journalizing. Because every time you need to journal, that's the first thing that you need to check before you can move on to the next one. Did your debits match your credits? Okay? Is this concept, is there any questions in regards to this concept?
No.
Okay? So again, single, you're only affecting one account. Double, you're utilizing two or more accounts. Okay. Okay, so course review. So again, we looked at what accounting is. We looked at the accounting equation, which is your assets equals liabilities plus equity. We looked at each normal balance for each one, which is the accounting model right here, right? Our assets are usually debited, right? So is our expenses. They usually are debited. They are increased with a debit. We understand that debit means left and credit means right. We also understand what the normal balance means, okay? We also looked at our permanent accounts and what they have here, right? Our assets typically have 3 categories: current, fixed, and other. Our liabilities have 2 categories: current and long-term. Our equity, right, I put it in caps right here, has no categories. Then you got your income and your expenses. They each have 3. But what you need to know is that non-operating for both of them, we don't really learn it in this class. All right. Okay. Any questions in regards to chapter 2?
For me yet, no.
Okay. So with that,
Sure, maybe more questions when you start doing the actual, like,
oh yes.
you know,
So
your paperwork stuff.
when we're doing the paperwork stuff, okay, so again, the first 4 chapters, it's pretty much like your lecture notes, right? Things that you jot down to try to help you remember, because all of this is conceptual based. But when we actually apply it, when we journalize for the first time, or when we actually start looking into calculations, then every single concept that you learn from chapters 2 all the way to 4 is going to apply seamlessly in there, okay? Everything that you do is going to be reflecting based on the chapters 2 through 4, okay? So let's go ahead and take a look at our chapter 2 exercise here. I'm going to I'm going to go ahead and stop the recording here because these are things that you're supposed